Hi, welcome to On Investors' Minds. I'm Tai Hui, the Chief Market Strategist for Asia Pacific at JP Morgan Asset Management, and thank you for giving us a few minutes of your time to understand what investors are thinking about right now and how that fits in with building the right portfolio. So gold hit $4,000 on October 8th and gained over 50% in 2025, one of the best performers in financial return this year. In this episode, I want to discuss why that's been the case and also the role gold could play in a portfolio construction. Now, gold's impressive rally really started back in late 2023 when it broke above $2,000 and as a result, doubling in less than 2 years. We see there are several reasons behind this rally. The first one is that global interest rates have been coming down. Since 2023, global central banks have started to bring interest rates lower, and this benefits assets with low or no yields. Now, the Fed is restarting its rate cut cycle, and as a result, it helps to add to this momentum. And overall depreciation of the dollar also helps to provide more support to gold as well. The second reason is that central banks around the world have also been adding gold to their foreign exchange reserve. The Chinese central bank have been a net buyer of gold for 11 consecutive months despite the rally. But it's not just the Chinese or Indian or the Russian central banks to be the only buyers. Central banks in Central and Eastern Europe, such as Poland, Turkey, and also in Central Asia, have also added gold in a significant way to their reserve portfolio. In the recent past, they've bought equivalent to 1/4 to 1/3 of the annual gold production. In addition to central banks, consumers, especially from India and China, are also demanding more physical gold as jewelry as well as investment. Third, gold could also be seen as what I called a disciplined asset. Its production did grow over the past 10 years, but only gradually from 3,000 tons a year to around 3,500 tons. The World Gold Council estimates that the total global stock of gold is around 210,000 tons, which means that this stock is only growing by 1 to 1.5% each year. Some investors may contrast this with a rapid rise of government debt, hence increase in supply, especially in developed economies. This lack of fiscal discipline could prompt some investors to increase their asset allocation to gold. Questions over central bank independence, potentially leading to higher long-term inflation, could also be another reason for investors to look more towards this disciplined asset. However, there are some discrepancies at this point between the performance of gold versus inflation-linked bonds, which have yet to show a material increase in inflation expectations. While gold price's momentum has been nothing short of spectacular, and some would rightfully ask whether technical correction is due, the drivers that we've discussed above do look intact, at least for the time being. I do think it's worth reiterating that the role of gold in portfolio construction. Some investors see this as a hedge against risk asset correction or risk aversion, but frankly, this characteristic does not appear in our analysis. First, it is worth noting that gold, over the long term, is still a volatile asset, with volatility higher than fixed income and similar to emerging market equities. Second, its correlation with equities is not consistently negative and hence does not serve as a good hedge against corrections or risk aversion. Most importantly, gold does not generate any income. While investors have done very well in the past 2 years investing in gold, the opportunity cost of holding gold when it's moving sideways can undermine total return compared with income-generating assets such as fixed income or high-dividend equities. Now, while there are some valid reasons to hold gold in a portfolio, other sources of return, such as from companies' earnings or interest payments on debt, can help to diversify portfolio risk as well as enhancing long-term returns. So thanks for listening. If you enjoyed this podcast, please share this with your friends and colleagues, and of course, consider subscribing. If you have any questions or topic you'd like to hear from us, please reach out to your JP Morgan Asset Management client advisors. I'm Tai Hui. I'll see you in our next episode to discuss what's on investors' minds. Meanwhile, stay informed and stay invested.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase and Company and its affiliates worldwide.